Hey everybody, Chris Karam here, Chief Investment Officer with Finspire. Welcome back to the Focus on the Market series, second quarter 2025. And yeah, you're right, we've got a lot to cover and a lot of very interesting stories to tell about the economy, the markets, what's happening in Washington, D.C., and what's happening with tariffs. We're going to cover all of that. We've got some tariff news, we've got the bulls fighting the bears in the market, we've got the Democrats and the Republicans, or the donkeys and the elephants, duking it out in Washington, D.C., so we're going to cover the globe as well as a few things that maybe you haven't thought about or haven't heard about as it may have been lost in the news shuffle with all of the tariff announcements in the last couple of weeks. Hey, I'm coming here from our new podcast studio, so we've got a little bit of a different background. We'd love for you to check it out and come see us. Come check it out when you come to see us at our offices. And we're going to get into things, not just recession. What is going on? Are these tariffs going to lead to a recession? But are we just simply reflecting on high equity valuations and where we just simply due for a drawdown in the equity markets? But then we're going to get into some detailed public policy on the concepts of rescission, which is something you may not have heard about before, and reconciliation, which is a form of budget reconciliation, which is being used to actually potentially pass new tax laws and tax reforms going into next month and maybe into the early part of summer. All of this has an impact on your money, so let's get to it. As usual, we're going to share with you some factual information coupled with our opinions on what's going on in the markets and in the world. So let's hit the capital market strategy board. The economy first. It's poised for negative growth in the first quarter. According to some estimates, according to the Atlanta Fed, it's poised for negative around 2% GDP growth in the first quarter. But the labor market doesn't tell you that. The labor market has been actually quite strong, consistently strong, and it's hard to have a recession without unemployment increasing. So will we ever get there? To be determined, but the risks now have changed, and the risks of a recession have risen because of the potential economic pause and disruption that the new tariff policies will have on the globe. It may not turn out that way, but the risks have risen. Okay, let's get into the markets themselves. The first quarter was not a good quarter for the S&P 500. It was the first 10% plus pullback since 2023. We didn't have one at all in 2024, so perhaps we were a little overdue. Bond yields fell in the first quarter, which meant bond returns, fixed income returns were higher. However, bond yields have been all over the place since the tariff announcements as the markets try to digest what is going on. Overseas equities had a nice rebound. They had a very poor fourth quarter. They had a rebound in the first quarter. And if you're getting the picture here, diversification matters. It really matters this year more than it has the last couple of years. Small companies have been a disappointment, though. If you're looking at diversifying, be careful in small caps. That's been an area that's been volatile. It's also been significantly underperforming their large cap brethren over the last couple of years. Okay, politics. We're going to get into this a little bit because it does have an unusually high impact potential on portfolios. We know that the tariff news is one side of the coin. The other side of the coin, from a cost perspective and from a tax perspective, is actual income tax policy. Congress is poised to pass a significantly sized bill. Could encompass things like tax rates, individual and corporate. It could get into things like border funding. It could also get into things like these new tariffs, and if any of them make their way into legislation. The other big news is what's DOGE doing. So the Department of Government Efficiency has, although they've uncovered over $100 billion or $150 billion of waste, fraud, and abuse in the government, in order for Congress to enact, to make those, to not only identify those areas of waste, fraud, and abuse, but the Congress then has to take action in order to cut the spending moving forward. We'll see if they can carry that through. In other words, if those DOGE cuts can find their way into congressional budget cuts and spending cuts. Let's not rule out the fact also, from a risk management perspective, that global peace, especially peace between Ukraine and Russia, is elusive. We saw the episode with Zelensky in the White House. That did not go well. We've seen now, ever since both parties have agreed to maybe a ceasefire, that they just keep fighting. And this can be disruptive to the global markets, especially to the Eurozone as we look ahead. So what do we do from an asset allocation standpoint? Look, this year diversification is more important than it has been the last couple. We mentioned that. Small cap equities, you could be a little bit cautious on them until there's much clearer policies around the tariffs, how that's going to impact small businesses across the country. Overseas equities, with the tariff policies, overseas countries may take it upon themselves to stimulate their growth, spend more, and perhaps spur more innovation, which has been somewhat elusive, especially in different parts of the world. That could actually make overseas equities quite appealing, along with a potential for a weaker dollar for at least for the rest of 2025 and maybe into next year. But then also fixed income and gold have been good diversifiers this year. Gold has been a big demand, especially with the global chaos, with the tariff news. So you have an unsettled conflict between Russia and Ukraine, plus you have economic upheaval with really the news of the tariffs, and with that, it's ripe for gold to continue to move higher. Maybe not in a straight line, but it's been quite strong. All right, so here's what it's looked like in the markets as it stood at the end of the quarter. So March 31st, commodities actually led the way so far in the first quarter of the year, followed by international equities at 7, emerging markets at +3. And you can see here the S&P 500 down 4.3%. Small companies in the U.S. down almost 10%. If you were to take a balanced portfolio, this is why we say diversification matters. Balanced portfolio, you would have finished about flat for the first quarter, plus or minus a few digits based on how your asset allocation fell. And you can see that's a pretty radical change from where we were the last couple of years, with the S&P posting 25+% returns in 2023 and 2024, really outpacing everybody else. This year has been different thus far. I mentioned this was in the first quarter we had our 10% pullback, which was the first time we had a pullback since 2020 of that magnitude since 2023. So the red dots represent the largest peak to trough pullback in the year, followed by the blue bar, which the bars here, which represent the actual rate of return, total return at the end of the whole calendar year. So the point I'm trying to make here is that even in drawdowns of 10, maybe even greater percents, in which you can see we have from year to year, even in some of those years where we have drawdowns of this magnitude, and as of today, the drawdown in the S&P was actually closer to 20% when you factor in the post-tariff announcements and volatility that shook the markets. But even in years like that, you can still have positive overall calendar years of performance. Really important for us to remember that, because the drawdowns are sharp and they're severe, but they also could be short-lived if this doesn't devolve into a recession. So that brings us to this question. Look, we added 220,000 jobs in the month of March. It's only a matter of time, however, to see if the tariff announcements have had an impact on unemployment. You can't really have an extended recession if you have the labor market adding 100, 2,000, 200,000 or more jobs every month. It's just very difficult because the calculations just don't work into negative growth on a sustained basis. Or was all this post-tariff announcement just a reflection? There's our second word of the day. We went from recession to reflection. Reflection on just simply how expensive the equity market was. I said in previous videos, market's expensive. It could get more expensive before it comes down. But ultimately, when you get close to the blue mountain in the back, which is the earnings generated by stocks, ultimately that when that S&P 500 starts to touch or get close to that earnings mountain, something usually changes. Either earnings fall and then the equity market falls, or earnings stay the same, but equities have a catalyst to drive lower because of their elevated valuations. And perhaps that's exactly what the tariffs were a catalyst to markets just reflecting on names, companies, indices that were perhaps a little bit more expensive than historical averages. And you can see here we've made a correction. As of March 31st, we made a further correction on valuation on S&P prices relative to the earnings mountain in April after the tariff announcements. And if you think about it, if you don't know what the earnings are going to be, it's very hard to know what the price is going to be. And that discovery period of time here post-tariff has brought significant more volatility to the U.S. equities and equities around the globe. So again, what is the Trump administration trying to address? And it's these trade deficits. You can have different economic beliefs about whether trade surpluses or trade deficits are a plus or a minus. You can get all sides of the argument, and you can see plausible arguments on all sides of that issue. But this is what the government, or was what the Trump administration is trying to address, is this trade deficit and try to bring it closer to level. And this has impact to certain regions and countries more than others. So a big focal point in these tariffs has been China, right? China retaliated instead of trying to negotiate with the Trump administration. So far, they've done a lot of retaliation about U.S. goods, raising tariffs, saying they're not going to allow Hollywood to sell movies into China, saying that China is going to withhold rare earth minerals to the U.S. for growth. It gets pretty nasty, right? But our biggest trade partners, Canada, for example, has also come in the news. I'm going to talk a little bit more about that because China and Canada, it's a bit more intertwined than perhaps we even realize, not just economically but also politically. So the administration is trying to address the trade deficit, but it could really put China in a rough spot when it's all said and done, because they do need the U.S. consumer to buy more Chinese-made goods. All right. So what is a tariff? We know the tariffs are taxes imposed by one country on another country from buying those goods, and they do it for a variety of reasons. So you place a tariff in order to protect existing industries in your country, jobs in a specific industry, whatever those competitive advantages are. But we've also heard the Trump administration is very concerned about national security issues and other areas where the tariffs are being applied, and that creates some confusion, right? Because once you get past certain tariff announcements, then you realize that there are certain countries where we're applying tariffs. For example, I'll use the China example to try to reduce the fentanyl. Components of fentanyl that make fentanyl so deadly are produced in China. And so that's been a big consideration. And so one of the reasons why tariffs are not the same on every country once you get beyond that 10% baseline. Are they inflationary? This is another one of those topics where you can get all sides, varying sides of the equation here on whether or not tariffs are inflationary. And tariffs can raise the cost of a good in the short run, but it's not necessarily a permanent status of inflation, especially if the consumer of those goods refuses to pay the higher price due to the tariffs. Then ultimately the seller or producer may have to actually bring their prices back down before the purchaser, the buyer, decides to move forward with that purchase. So there is a lot in it, and a lot of it has to do with the elasticity of the different goods that are subject to those tariffs. So it's an inflation question mark. In some cases, yes, in the short run. Other cases, you could argue it's actually deflationary in some goods in the longer run. So the answer is depends. That's why you can get varying degrees of assessments on whether or not tariffs are inflationary. But tariffs are only one part of the puzzle of this economic rebalancing that is desired by the Trump administration. The other side of the coin is, okay, if goods are going to be tariffed and we as consumers are going to have to pay higher prices for them, then what are you giving me on the other side to balance it out? And that's the income tax equation. So the income tax equation is interesting because in the first Trump administration, they focused on tax policy first, tariff policy second. In Trump 2.0, we're doing tariffs first and tax policy second. So remember, these things go hand in hand, and to balance as a form of rebalancing of not just the revenue of the United States going to the United States Treasury, but also impacting individuals' income statements and families' income statements about where the expenses are increasing, where the taxes are increasing, tariffs, where the tax expenses are decreasing, potentially the income tax and corporate tax rates, which are poised to come, we've been told, by the end of May. We'll see. Congress, the House, especially the House, has a slim majority, and they've got to work with the Senate. House Republicans, Senate Republicans don't always get along, but nevertheless, they are engaging in a form of what's called reconciliation. And tax reform bills, they got to make their way through the House, and in this case, when they're trying to make all the costs as neutral as possible, in order to qualify for this process of reconciliation, which allows the U.S. Senate to pass a budget measure that includes things like tax policy changes with a majority vote. So you just need 50, in this case, 50 votes plus the Vice President Vance would give you the majority for that bill to pass, instead of a north of 60 vote threshold, which is the filibuster threshold to break the filibuster and debate on an issue. And you can only do that if the budget is at a certain level, at a certain surplus or deficit figure going into that reconciliation process. So it's very tricky. At the same time, Congress has already passed some preliminary bills and measures to make this reconciliation, makes taxes part of the reconciliation package a real thing, a real potential. And if you just look at the backdrop here of U.S. tax rates, look, there's a lot of talk about things like no tax on tips, no tax on Social Security, raising the threshold for the lower tax brackets, which you can see here. The lowest tax bracket really covers a married couple up making up to just shy of $24,000, and you can see all the way up to the top tax bracket, which shows married filing jointly of earning $750,000. And there's all kinds of room in the middle here for adjustments and reforms, and we'll see where they go. Part of this process, or almost tangential to this, is something called rescission. This is not something that has been commonplace within the halls of Congress, but it is an option. And you're going to hear more about this concept of rescission. This is not reconciliation, this is rescission. So if DOGE, for example, identifies a certain number of spending cuts or waste, fraud, and abuse that should be identified and targeted for spending cuts, and perhaps those expenditures were not in sync with the original purpose or intent of congressional appropriations, then Congress, and if the president views it worthwhile, then the U.S. Senate can engage in the process of rescission. And rescission basically cherry picks different spending amounts on different spending bills that should never have been there in the first place. The U.S. Senate has the ability to do this. So in this case, DOGE, which identifies all these potential for waste, fraud, and abuse, these expenditures, could then be translated into a rescission process that the U.S. Senate, and you can see there's Senator John Thune, who's the Senate Majority Leader from South Dakota, is going to be here, is going to become front and center on this and leading the way on whether or not money gets essentially pulled back from what was previously approved by Congress, perhaps in a previous Congress. It's very intricate, but it's also a process that the U.S. Senate might take up. Again, they may do this in order to make some of these budget reconciliation bills more palatable for congressional approval, and you can see why, right? You can see this is sort of the scary chart, if you will. Don't want to scare you, but the scary part is, as interest rates have climbed over the last several years, especially off their lows from post-COVID, when interest rates were really close to zero, it was a lot easier to finance our debt. Our debt's since grown. Our deficits have remained quite stagnant, around $2 trillion, $1.5 to $2 trillion in size per year. It's really a massive challenge for Scott Bessent, who you see here, who's the Treasury Secretary, who has to refinance the debt from debt that was originally purchased 5 years ago. It's anywhere from $6 to $9 trillion of debt needs to be refinanced, and that is an enormous challenge. So the Treasury Secretary, who you've probably seen more and more on the news lately, Scott Bessent, this is an enormous challenge. So it's in their interest to bring bond yields down, and you can only do that in a good way by cutting spending and lowering inflation. It can also happen in a bad way by having an economy that's weakening. Okay, so it is a very difficult situation that the Treasury Secretary finds himself in, especially as it relates to refinancing our debt, which is taking up more and more of our budget. So that's why some of the budget cuts may become more prominent and become larger in order to help facilitate those more expensive financing rates of the debt with these new 5-year bonds that Treasury Secretary Bessent has to purchase after the ones from purchased right after COVID are now maturing. All right, so the bond market has been all over the place. Bond yields have been all over the place. They went lower in the first quarter. They jumped over 4.5% on the 10-year yield You can see here at the quarter end, the 10-year yield finished around 4.2. It jumped as high as over 4.5% in April after all the tariff volatility in the equity and the bond markets. It's now sort of settling around 4.35-ish or so today, but it has been a very volatile ride. So bonds can be volatile like equities, especially when there's a lot of unknowns and uncertainty in the global markets. One thing that's been a real bright spot has been gold. So although gold and equities have very low levels of correlation, gold has had appeal for us, at least for our clients, for several years, going back to 2022, and has been really strong. So actually this gap, even post March 31st, this gap has further closed with the S&P falling a little bit and gold moving higher considerably in the month of April with all of the uncertainty in public policy and in global foreign affairs. So don't forget gold as a decent diversifier in a portfolio. All right, what you may have missed, and I think these stories are interesting. They don't have a direct connection to the capital markets, to the equity markets, the bonds, etc. But they're interesting. The timing of these events were interesting because first I want to point to two news articles here. The first one you can see on top. China, so almost inexplicably, in a very forceful fashion, executes 4 Canadians what they considered over drug-related crimes. And now, drug crimes in China are very serious, they're very severe, but these individuals had dual Canadian and Chinese citizenship. And these executions of Canadians in China really shook the Canadian leaders and shook the Canadian population, as you might imagine. That these types of executions for dual citizens are unusual, regardless of where you are. But the impact that have, little did China realize, or did they consider, or had the even foresight to consider, that this was 2 weeks before the tariffs were announced. And Canada who's one of our biggest trading partners in the U.S., or one of U.S.'s biggest trading partners, had an interesting opportunity to perhaps use the Chinese against us in these trade talks. Not saying that they would, but in order to find a better deal for themselves. After that occurred, because it was so raw and fresh with the Canadian citizenry, the relationship, as you might imagine, between Canada and China has melted down. So it actually, in my opinion, may have drawn Canada closer to the U.S. even after these tariff announcements, because having China as an alternate trade partner, they just couldn't trust them, of course, after that occurred. So it's not something that was big in the press, but I think it was a global action that actually had significant ramifications that perhaps nobody saw coming 2 weeks later in this case, after that horrible tragedy that the tariff announcements rose, and then I think it actually will help Canada draw closer to the U.S. despite some of the real strong rhetoric that's been going on between different Canadian premiers and the United States government. Okay, second item is on April 4th. Now you can't predict this stuff, but it does happen. Saudi Arabia, as part of one of their OPEC Plus meetings on April 4th, much to the surprise of the commodities markets, decided that they didn't like how Kazakhstan and Iraq were, let's say, maybe increasing output as the oil prices were higher. And so they sort of shocked everybody by increasing their output. And they also announced that they found new areas within their country that they could drill for oil. Well, this was a big shock to the oil markets. It plunged oil prices. Oil prices today per barrel are hovering around $60 a barrel, which is significantly lower from the mid-70s and low 80s where oil has been trading for the last, call it, year and a half or so. Now, why is that important? In March, we just got the inflation data, which showed deflation in the consumer price index and deflation in the producer price index month over month for the month of March. Doesn't mean that there's deflation happening year over year inflation is still a challenge, but energy prices going lower were a major contributor to lower production costs and lower prices in the month of March. So this was trending this way as the economy was started to slide, oil prices started to slide, and then in April, oil prices really took a bump lower due to other global events that occurred that you can't really necessarily predict. So oil prices are at the lowest level since 2021, which is only helpful to the inflation story, which is a big help to the Trump administration in these negotiations with tariffs, because it keeps some of the global markets calm when you have lower energy prices along the way. So yeah, we covered the globe. There's a lot of highlights, maybe some lowlights, but we want to thank you for watching and listening. Just as a note, you can follow us and get more of these videos off our YouTube channel, the Finspire YouTube channel, where you can subscribe. Feel free to do so. And look, please feel free to reach out to us. We're going to continue to produce different forms of content, whether it's video content, written content, other things to keep you aware of what's happening in the global economy and also in the global markets. And we just want to wish you, this is a very special week. Obviously, it's Holy Week. This is on Sunday, Easter Sunday, will be celebrated by all Christian faiths on the same day this year, which is kind of unique. And then also Passover concludes on Saturday. So we want to wish you a very prayerful and joyous holiday season here, and happy Passover and Easter to everybody watching and listening. And we are looking forward to seeing you soon and talking to you soon. Thanks so much.